Debentures.
My son told me that his company is expanding and that they plan to raise the funds from the public.
Times have sure changed, and so have styles of functioning. In our times, if we wanted funds, we sold our gold and got good cash. What was wrong with that?
Shanti, it's a company. They need a lot of funds. How much of gold would they sell to finance their projects?
So are they planning to issue shares to the public? But the company is not doing too well. Why would anybody purchase their shares?
The board of directors are planning to issue debentures to the public.
Debentures? Why debentures?
Yes, debentures. Shanti, let me tell you something about them.
What are debentures? A debenture is a document which either creates a debt or acknowledges it. Basically, a debenture is represented by a document or certificate signed by the authorized officers of a company, acknowledging money lent and guaranteeing repayment with interest and with or without security on the assets of the company for due performance of its obligation. This is a debt instrument and is the commonest method of raising loan capital at a lower cost as part of project financing or for any other purposes. Types of debentures. From the point of view of security. Secured debentures. These debentures are secured by a charge on the assets of the company. These are also called mortgage debentures. The holders of secured debentures have the right to recover their principal amount with the unpaid amount of interest on such debentures out of the assets mortgaged by the company. Unsecured debentures. Debentures which are issued without any charge on assets are known as unsecured debentures. The holders are like unsecured creditors and may sue the company for the recovery of debt. These are also called as simple debentures. On the basis of redemption. Redeemable debentures. Normally, debentures are issued on the condition that they shall be redeemed after a certain period. They can, however, be reissued after redemption. Non-redeemable debentures. These debentures are not redeemed in the lifetime of the company. Such debentures are paid back only when the company goes into liquidation. Perpetual debentures cannot be issued in India at present. On the basis of records. Bearer debentures. These are registered and are payable to the bearer. They are negotiable instruments and are transferable by delivery. The holder of these debentures is entitled to get the interest. Registered debentures. They are payable to the registered holder whose name appears both on the debentures and in the register of debenture holders maintained by the company. Registered debentures can be transferred, but they have to be registered again. Registered debentures are not negotiable instruments. A registered debenture contains a commitment to pay the principal sum and interest. It also has a description of the charge and a statement that is issued subject to the conditions endorsed therein. On the basis of records. Convertible debentures. These debentures can be converted into shares of the company on the expiry of pre-decided period. The terms and conditions of conversion are generally announced at the time of issue of debentures. On conversion, the holders cease to be lenders and become owners of the company equivalent to their holdings in the company. Convertible debentures have become very popular in India. Non-convertible debentures. These debenture holders cannot convert their debentures into shares of the company.
What else? Too many newfangled notions.
Shanti, relax. There are so many new things. We never heard of all these things in our younger days. A few more aspects to note.
Now what does that mean?
This implies that the debenture shall be paid proportionately. This is an important aspect, especially when the company is short of cash and does not have sufficient funds for the payment of its debentures. In such a situation, all the debentures held by a creditor of the company are of equal rank as regards to charge and repayment with the others of that series.
But what if the debentures are not issued with a Pari Passu clause?
In absence of the Pari Passu clause, the debenture holders are paid according to the date of issue of debentures. In case all the debentures were issued on the same date, the priority would be based on their consecutive numbers. Also, unless it is expressly authorized, a company cannot give the Pari Passu right to new debenture holders.
New debt instruments issued by public limited companies are participating debentures, convertible debentures with options, third-party convertible debentures, convertible debentures redeemable at a premium, participating debentures, convertible debentures with options, third-party convertible debentures, convertible debentures redeemable at a premium,
And what about getting rupees 1 lakh by investing only rupees 2,700?
Oh, you mean deep discount bonds? ICICI was one of those who had issued unsecured redeemable bonds in the form of deep discount bond. Here, investment was for an amount of rupees 2,700 for a period of 25 years. The investor would receive rupees 1 lakh on maturity. It was a very popular scheme.
Why were they discontinued? Then,
As per the terms and conditions of the prospectus, both the bondholders and the company had the right to exercise early redemption offer on specified dates. The first date for exercising this call was in July 2001. In accordance with the same, these bonds were called back by ICICI. It was just a matter of prudence. Let me make you understand as a businessman. If you want to calculate the number of years in which your money would double, there is a simple formula. Divide 72 by the current rate of bank interest. Simple. Let us take the current bank rate, which is approximately 8%. In such a case, dividing 72 by 8 would give us 9. Hence, in 9 years, approximately rupees 1000 would become rupees 2000, given the bank rate to be 8%.
so,
In the year 1996, the banks were offering 16% interest.
all this is very nice. But why debentures? You still haven't convinced me. Why would a company raise debentures?
I'm just coming to that.
Why debentures? The companies can raise long-term funds by issuing debentures. These debentures have a short rate of return for investors in the form of a fixed rate of interest. The cost of debentures is much lower than the cost of preference or equity capital, as the interest is eligible for deduction under taxation. Also, investors consider debenture investment safer than equity or preferred investment and hence may require a lower return on debenture investment. Debenture financing does not result in dilution of control, as debenture holders do not have voting rights in a firm. In a period of rising prices, issue of debentures is advantageous to the company. The fixed monetary outgo decreases in real terms as the price level increases.
Now is the rapid fire round to really convince me.
Go ahead and fire.
Is there anybody to protect the rights of the debenture holders? A company which issues debentures is under an obligation to create security under Section 117A of the Companies Act by executing a trust deed. This legal requirement arises when a company wants to issue a prospectus or letter of offer to the public for securing subscription to its debentures. It is for this purpose the company appoints one or more debenture trustees. The trust deed should clearly state that the debenture trustees have consented to be appointed as required by Section 117B of the Act. A debenture trustee is an independent entity unconnected with the issuer of security, but nonetheless appointed to protect the interest of holders of debentures. What is the role of the debenture trustee? The debenture trustee is an intermediary between the issuer of debentures and the holders of debentures. The main responsibility of the debenture trustee is to Can a private company issue debentures and appoint debenture trustees? A private company is prohibited from inviting the public to subscribe to its shares or debentures. However, if the articles of the company empowers the board to borrow by issuing debentures and creation of security, the company may issue debentures on a private placement basis. All other provisions of the Act as applicable to a public company will apply, except that it may not be required to appoint a debenture trustee. Merits of debentures. Debentures are secured loans. On the winding up of the company, they are repayable before making any payment to the equity and preference shareholders. The debenture holders get an assured return irrespective of profit made by the company. Issue of debentures enables the company to provide high return to equity shareholders when the earnings of the company are good. This is called trading on equity. Debenture holders have no right either to vote or take part in the management of the company. So, by issuing debentures, the company raises the additional capital without diluting the control over its management. Interest paid on debentures is treated as an expense and is charged to the profits of the company. The company thus saves income tax. In case of convertible debentures, if the company performs well, they are likely to be converted to equity. In such a case, it is beneficial to the company as the extra resources, debentures, are transformed into own resources, shares. Demerits of issuing debentures. If the earnings of the company are uncertain and unpredictable, the issue of debentures may pose serious problems due to the fixed obligation to pay interest and repayment of principal. Irrespective of whether the company earns profits or not, it must pay the interest on debentures. The company which issues debentures creates a charge on its assets in favor of debenture holders. So, a company that does not have enough of fixed assets cannot borrow money by issuing debentures. The assets of the company, once mortgaged, cannot be used for further borrowing. So, the issue of debentures reduces the borrowing capacity of the company. In case the company fails to pay interest on debentures or repay the principal amount, the debenture holders can recover it from sale of its assets. Did you know? Preference share capital. Preference shares means shares which fulfill the following two conditions. It carries preferential rights in respect of dividend at a fixed amount or at a fixed rate, and this dividend must be paid before the holders of the equity shares can be paid dividend. It also carries preferential rights in regard to payment of capital on winding up or otherwise. It means the amount paid on preference shares must be paid back to preference shareholders before anything is paid to the equity shareholders. In other words, preference share capital has priority both in repayment of dividend as well as capital. Types of preference shares: convertible and non-convertible preference shares. Cumulative and non-cumulative preference shares. Participating and non-participating preference shares. Redeemable and irredeemable preference shares. Merits of preference shares. From the company's point of view, preference shares are advantageous in that dividends do not have to be paid in a year in which profits are poor, which is not the case with interest payments on long-term debts, loans or debentures. Since they do not carry voting rights, preference shares avoid diluting the control of existing shareholders, while an issue of equity shares would not. Unless they are redeemable, issuing preference shares will lower the company's gearing. Redeemable preference shares are normally treated as debt when gearing is calculated. The issue of preference shares does not restrict the company's borrowing power in the sense that preference share capital is not secured against assets in the business. The non-payment of dividend does not give the preference shareholders the right to appoint a receiver, a right which is normally given to debenture holders. Demerits of preference shareholders. Dividend payments on preference shares are not tax deductible in the way that interest payments on debts are. Preference capital dilutes the claims of equity shareholders over the assets of the company. For the investor, preference shares are less attractive than loan stock because they cannot be secured on the company's assets. Preference shares are not suitable for those investors who are willing to take a risk and are interested in higher returns.
Just look at the time. We have been here so long. Thank you, Lata, for teaching me so much.
So you do agree that debentures are an essential way to raise finance.
But I still believe in selling gold.
Like they say, habits die hard. But if you wish, do understand the merits of investing in gold ETF in future.